Hi, I'm Gerald David, president of Arca Labs again. I'd like to introduce J. Christopher Giancarlo, the Honorable J. Christopher Giancarlo, who serves as the 13th chairman of the U.S. CFTC. Mr. Giancarlo is considered one of the most influential individuals in the field of financial regulation, and he's also been a member of the U.S. Financial Stability Oversight Committee, the President's Working Group, the PWG on financial markets, and the executive board of IOSCO. Mr. Giancarlo's book, Crypto Dad, The Fight for the Future of Money, is his account of his own oversight of the world's first registered market for Bitcoin derivatives and the coming transformation of financial services. Mr. Giancarlo, senior counsel to the international law firm Wilkie Farr and Gallagher, is a director, advisor, and angel investor in numerous technology and financial service companies. He is co-founder of the Digital Dollar Project, a not-for-profit initiative to advance the exploration of the U.S. central bank currency. Since his release of Crypto Dad in late October, Mr. Giancarlo has been a featured speaker in numerous events throughout the U.S. and internationally. He's focused on cryptocurrency, banking, the financial industry, and the coming digital economy. He has been interviewed on radio shows and podcasts, both in the U.S. and internationally. It's now my pleasure to introduce this afternoon's keynote speaker, the Honorable Chris Giancarlo.
Everybody, it's great to be with you this afternoon. I'd like to spend a few minutes with you today to tell you about the digital transformation of money and how it's going to change the lives of each and every one of us. As Gerald mentioned, I've just written a book, Crypto Dad, The Fight for the Future of Money. The book's a personal story. It's a story of my 37-year career and that intersection of law, markets, and technology, first as a Wall Street lawyer and later as an executive with GFI Group, an interdealer broker of over-the-counter derivatives. GFI became the world's leading broker of credit default swaps, only to find itself in the epicenter of the 2008 financial crisis. And that experience led me to support reform of global financial markets, including the U.S. Dodd-Frank Act, a law that I now view as the last major patch of the longstanding analog account-based financial system. Those experiences resulted in my appointment to one of the world's least understood, yet perhaps most important financial market regulators, the U.S. Commodity Futures Trading Commission, CFTC. I was first appointed by President Barack Obama and unanimously confirmed by the Senate, and I was subsequently elevated to the role of chairman by President Trump, and again unanimously confirmed by the U.S. Senate. I went to Washington in 2014 as a political amateur with reformist goals. My immediate objective was to complete and improve reforms to the over-the-counter derivative markets. Yet halfway through my term, I was staring at the first ripples of the next wave of the internet of value, of Bitcoin, and of cryptocurrencies, a wave that I believe will shake the existing financial system to its core. The immediate challenge in 2017 was a new futures market product called Bitcoin futures, and I faced significant pressure to prevent it from being launched. But I resisted that pressure, not without a few moments of self-doubt. Instead, I led the CFTC to encourage financial innovation, prepare for the internet of value, and oversee the development of crypto derivatives. By braving political risk, the CFTC reduced regulatory uncertainty for financial market innovation. The decision to allow the launch of Bitcoin futures paved the way for the emergence of an enormous new ecosystem of retail and institutional cryptocurrency greater than anything I could have anticipated. And for that reason, the online crypto community dubbed me Crypto Dad, which I've used as a title for my book. So what I'd like to do today is offer you 3 key observations about financial markets from my time as a senior financial regulator. And first, I'd like to consider or ask that you consider that the physical infrastructure of the United States and many parts of the developed world, its bridges and tunnels and airports and mass transit systems that were cutting edge in the last century have been allowed to age and deteriorate in the current one. Well, sadly, the same is true about much of our financial infrastructure, both in the United States and in many developed Western economies. Systems for check payment and settlement, shareholder and proxy voting, investor access and disclosure, and even financial system regulatory oversight that were once state-of-the-art and global models in the 20th century have fallen behind the times in the 21st century. And in some cases, that's embarrassing. Here's a good example. It typically takes days in the US to settle and clear retail bank transfers, while in many other countries it takes mere minutes, if not seconds. It also takes days to settle securities transactions and weeks to obtain land title insurance. It's often faster to move money around the globe by stuffing cash in a suitcase and carrying it on a plane than it is to send a wire transfer. And nothing better reveals the limits of the existing financial system than the US government's initial financial response to the COVID-19 pandemic in the spring of 2020. Tens of millions of Americans had to wait a month or more to receive relief payments by paper check, and many of them didn't have a bank accounts to deposit those paper checks. And more than 1 million payments were made to people who were dead. A second observation is that these aging financial and regulatory systems are struggling to adapt to the next wave of digitization that I and some others call the Internet of Value. Now, the first wave of the Internet was an Internet of Information. Wikipedia is an example and an emblem of that first wave, a massive decentralized online reference authority composed collaboratively by volunteers. That initial wave took information written and owned and controlled by elite publishers, like Encyclopedia Britannica, and democratized it, rendering it easily accessible at a keystroke, anytime, anywhere, and for free. That first internet wave was superseded by another wave, the Internet of Things. And thanks to this wave, seemingly every place we shop and dwell, everything we wear and drive, and every device we engage with is connected to the Internet. We're now on the cusp of the Internet's next wave, the Internet of Value. And as remarkable as were the earlier waves, the Internet of Value will be an even deeper transformation of our economic selves than the earlier waves combined. The Internet of Value would do to currency, financial instruments, and economic activity what the Internet of Information did to knowledge. It will reduce costs, increase speed, transcend barriers, improve accessibility, enhance certainty, and decrease bottlenecks to instantaneous transactions around the globe. In this wave, things of value, such as contracts for energy, agricultural and mineral commodities, stock certificates, land records, and property titles, cultural assets like music and art, and personal assets like birth records and driver's licenses will be stored, managed, transacted, and moved around in a secure, private way from person to person without third-party intermediaries. This next wave of the Internet will shift the medium of trust from large, centrally managed institutions to person-to-person digital handshakes powered and secured by cryptography, tokenization, and shared ledgers carried across a network of personal computers and smartphones. Think of the ability to send money or confer ownership over property by mere text message without having to go through an intermediary, such as a powerful bank or a credit card company, to authenticate who you are and the person you are sending it to. The opportunities will be no less transformative than what Uber did to mobility, Airbnb did to lodging, and Amazon did to commerce. And we're only in the early innings of what will be a decade-long digital revolution. It's naive, I believe, to think that the Internet will not have the same transformational impact on financial services and money that it's had on retail shopping, communications, photography, journalism, and so many other industries. In a few years' time, writing a paper check will be as archaic as sending film to Kodak to be developed. So will sending money by wire transfer, or even via mobile apps like Venmo or Square Cash, since all these ostensibly digital methods still rely on costly intermediaries, such as payment services and credit card companies. Just over the horizon is a world in which we'll soon send things of value directly to the recipient, mobile device to mobile device, without any third party needing to assist or take a cut. Some people refer to this world as Web 3.0, an evolution of the Internet that enables new forms of direct human collaboration, less dependent on a few powerful big tech intermediaries. This Web 3.0 Internet will be built on new emerging technologies of digital assets and decentralized finance, DeFi, blockchains, smart contracts, digital tokens, and decentralized autonomous organization, DAOs. Together, these technologies can allow us to take greater control over our financial selves while unlocking financial access for millions of underbanked people. And nowhere will the next wave of the internet have a more dramatic impact than in the realm of money. Sir John Cunliffe, the widely respected deputy governor of the Bank of England, once commented to me that every several generations, society re-asks the question, what is money? And he thinks this latest internet wave is prompting society to ask that question right now. And he's right. Society has been questioning the nature of money for over a decade now. Bitcoin, rising from the ashes of the last financial crisis in 2008, was the first digital asset. It's just the beginning. In the past decade, the private sector has launched thousands of budding non-sovereign cryptocurrencies of lesser or greater promise. And of course, that includes Ethereum. It also includes stablecoins, which have rapidly grown into a part of the digital asset ecosystem, moving billions of US dollars and other currencies around the globe in seconds, 24/7, 365. In only a short period of time, stablecoins have become a faster, cheaper, and more programmable way to move value. Clearly, the private sector is way ahead of governments and central banks in exploring digital money. But lately, governments are starting to react. Most of the world's central banks are now taking a serious look at a sovereign form of cryptocurrency called central bank digital currency, or CBDC. It seems there is a new CBDC announcement every day. The Bank for International Settlements has just announced that the central banks of Australia, Malaysia, Singapore, and South Africa will test CBDCs for international settlements. And India's central bank has said it could begin trials for a digital rupee by December. Perhaps most importantly, last week, the US Federal Reserve Board issued a discussion paper considering the merits of a potential US CBDC and inviting public comment on potential development. The paper is a curtain raiser for more Fed CBDC exploration in the year ahead. And the Fed is not alone. Today, over 80% of the world's central banks are considering central bank digital currency. In my book, I list 7 reasons why central banks are irrepressively drawn to CBDC. And they are access to citizens' economic data, financial infrastructure modernization, furthering financial inclusion, greater precision in monetary policy execution, the competition from the success of stablecoins, expansion of geopolitical influence, and what I think is the most important is expression of social and civil values. The world as we know it today is one of competing currency zones in which monetary systems, banking, and foreign accounts are generally oriented to one reserve currency or another. Think of the US dollar zone and the Eurozone. As I explain in my book, these old currency zones may well be replaced tomorrow by widely networked and integrated CBDC zones. There likely will be a Chinese digital RMB zone, it's what it calls its ECNY, and perhaps a digital Eurozone. In these zones, central bank digital currencies will be networked through distributed ledgers with all important financial functions and transactions, including retail credit and business lending, domestic and global payments, securities and commodities trading, and central bank monetary policy under the control and watchful eye and sway of powerful central banks. The increase in speed, efficiency, and velocity of money could turbocharge economic growth. Such centralized economic and financial control for major world economies would be unprecedented. My third and final observation is that the standards, protocols, and rules for the digital future of money are being established today. If we act now, we can make sure that democratic values, freedom of speech, individual economic privacy, free enterprise, and free capital markets are encoded in the digital future of money. In so doing, we can harness this wave of innovation to maximize financial inclusion, capital and operational efficiency, and economic growth for generations to come. But if we do not act wisely and promptly, This new internet wave will lay bare the shortcomings of the legacy analog financial system. Worse, it will mean that the values of our non-democratic economic competitors, values of state surveillance, social credit systems, law subservient to the state, and centrally planned economic activity will be embedded into the future of money, diminishing the vibrancy and health of the global economy, individual liberty, and human advancement. I'm convinced that money is changing right before our eyes, and we must take hold of that change. Money is as much a social construct as it is a government one. Democratic societies must assert their voice in the digital future of money. In fact, I'm so convinced that the internet is going to dramatically change the nature of money and possibly the values it represents that almost 2 years ago, I co-founded the Digital Dollar Project. It's a think tank devoted to the public discussion of the challenges and opportunities of a US Cbdc, or what we termed a digital dollar. Its work is published at digitaldollarproject.org. Among other issues, the Digital Dollar Project is concerned with what civic values must be encoded in a US Cbdc. Without inviolable protections for such civil liberties as freedom of speech, free enterprise, and individual economic privacy, digital dollars, digital yen, or other forms of digital currency would be no more worthy of a democratic people than the currency of an authoritarian one. Free societies have everything to gain by coding into sovereign and non-sovereign digital currency stout protections for individual liberty and privacy. Free people have everything to lose by neglecting it. The choice is essential to the future of civil society. Yet other values of money are possible in the digital future, promulgated by both sovereign and non-sovereign issuers of digital money, such as commercial and political surveillance, data mining, economic censorship, and social credit scoring. Over the coming decades, a battle will wage over what the digital money of the future, sovereign and non-sovereign, will look like. What values will it contain? The battle over the digital future of money will be waged by a range of players: the legacy financial system, big tech, new innovators, regulators, and central banks of both democracies and dictatorships alike. Yet there's another group that must be engaged in this battle. That is, you and me, our fellow citizens. That's one of the reasons why we formed the Digital Dollar Project, to make sure the voice of the private sector, of private citizens, is brought to bear in the evolution of a digital dollar. Looking back at the carnage of World War I, French Premier Georges Clemenceau is said to have remarked, "War is too important to be left to the generals." In my book, I adapt Clemenceau's famous quote to say that money, especially the digital money of the future, is too important to be left to central bankers. And I mean no disrespect whatsoever to central bankers. I just mean to say that whenever the United States does big things technologically, whether it was exploring outer space or exploring cyberspace, we always did so as a partnership between the private and the public sectors. Exploring the future of money should be no different. And that's why I wrote my book, to tell a general audience that change is coming, that the money of tomorrow will be very different than the money of today, and that we have everything to gain if we get it right: greater financial inclusion, lower costs, greater speed, and better individual control of our financial information. And yes, constitutional protection for individual liberty and privacy. And free people have everything to lose if we get it wrong. The fight for the future of money is afoot. The time to engage is now. And thank you, and I'm looking forward to a discussion.
That was great. Chris, thank you so much for delivering those remarks. Super interesting. I think you covered a tremendous amount of territory. I think you gave some really, really interesting insight, your time at the commission, and then ultimately, kind of where you feel the priorities are and where you feel your time is best spent since you have left with reference to the Digital Dollar Project. So thank you for everything you've done for the markets and for the industry thus far. I've got a whole list of questions that I thought about after listening to you speak. So I'm going to run a couple at you. And the first one I think revolves around timing. And you mentioned that you first found crypto halfway through your term at the CFTC. So I'm assuming that's going to be somewhere in 2015, 2016 or so. And wildly in another corner of the internet, I was working on something related. We were working on creating the second BTF application that we submitted to the SEC, which coincidentally was a futures-based ETF. So at the time, I was very, very tuned in to what kind of the CME was working on that ultimately ended up in your lap at the CFTC. And they were working on things like the BRR at that time in preparation for the launch. So I'd love if you could talk a little bit about that experience, because it was such a wild time in the markets. There were full-page ads in the newspapers, regarding the potential action that the CFTC was going to, allow for the CME and the CBOT at the time to trade futures and digital assets. The banks were furious with the CME. The FCMs were up in a tizzy because they weren't sure that they were comfortable even managing collateral positions. All of it proved to be wrong. Now at this point, kind of the CME came out with an announcement yesterday that they've got 400,000 retail accounts actively trading on the CME right now, 150,000 of which are new over the course of the past couple of months. So feels like tides have changed. But what were you going through back at the time?
Well, so I write about this in my book, Gerald. I mean, because it really was an amazing time, quite frankly. In 2015, I gave a speech to talk about the importance of blockchain. In 2016, I called for a do no harm regulatory response to the growth of blockchain technology. In 2016 is when CME actually started tracking an index for Bitcoin, which quite frankly was a giveaway as to where that was headed. And I was in 2015, I received a formal visit at the CFTC from Cameron and Tyler Winklevoss, and I write about that in my book. That was an eye opener as they talked to me about Bitcoin and more broadly sort of the new Internet of Value. And I really started doing my homework and started studying. And so when I became chairman in 2017, I had a strong hunch. We had a strong belief that Bitcoin futures are on the horizon. And that was the year in which Bitcoin 1.0 started rising. We were following it very, very carefully. Even before we were approached by some of our exchanges about launching Bitcoin futures, we formed Labs CFTC, and one of its first instructions was to start tracking crypto. And at our CFTC weekly market oversight meeting, which takes place every Friday morning, I asked them to add to the basket of products they were monitoring. They monitor a basket of commodities, of metals, of energy products, of indexes. And I said, add Bitcoin to that. And so we were monitoring the market. We were monitoring movements even before we were approached in the summer of 2017 by first CBOE, and then in the fall of 2017 by CME about launching Bitcoin futures. And again, I talk about this with a lot of detail in my book. I think people like you that were following it will find it very interesting. And as we did our analysis, we also knew that there were applications at the SEC for ETF products. And so we were already thinking at that process, as we were processing the Bitcoin futures applications, about what impact that might have if the SEC moved forward. And we formed a joint CFTC SEC crypto task force that began meeting every 2 weeks to look at some of these issue sets. And as you note, around the same time, there was all kinds of responses. There were overseas regulators that were calling me saying, or addressing me at international body meetings, look, you really can't go forward with Bitcoin futures, because if you do, you will be legitimizing Bitcoin. And after I heard that same phrase 3 times or 4 times, I started actually pushing back. And I said, look, I'm an unelected unelected bureaucrat. It's not up to me to legitimize or not legitimize a legal instrument. It's for the marketplace. In fact, CFTC regulated exchanges have overseen the launch of over 12,000 new products since 2020. Many of them went nowhere. The market, it didn't legitimize them. And the ones that took off, the market legitimized them. It wasn't for a bureaucrat to legitimize. It's for if we believe in a market-based economy, then we must trust markets to be the ultimate legitimizer of whether something serves a social or a business or a commercial purpose, not for bureaucrats. And so, notwithstanding full page ads, as you mentioned, in the Wall Street Journal, addressed to me as chairman of the CFTC, saying, don't let Bitcoin futures go forward, we did. And it wasn't long after that, after the launch of Bitcoin futures in December of 2017, that I received a formal notice from the Senate Banking Committee to appear before it alongside Jay Clayton. And by the way, Jay had not greenlighted Bitcoin ETFs. In fact, was taking a fairly hard line against the ICO explosion. That we were both called to basically defend our approaches to crypto. And I think it was a couple of nights before Jay and I were having a drink together. And I said, Jay, look, depending on who's asking the question at this banking committee hearing, one of us is going to be a jackass and one of us is going to be a goat. It's probably going to change depending on which senator is asking the question, but back and forth, it's going to be that. And it was at that hearing that, although I had prepared a long briefing document explaining all the steps we had taken to Bitcoin futures, I decided I was going to handle it in a different way. And I said, senators, if you don't mind, I've submitted a formal document, but I know I'm here as the head of a regulatory agency. I just want to talk to you as a dad for a minute. And I explained to them that my brothers and I had tried to interest our kids and our nieces and nephews in the stock market for years, and there was no interest. But suddenly they were all interested in crypto. And I said, senators, you've probably had some of these same conversations at your dinner table. And I think we owe it to them to come up with a forward-leaning, thoughtful, intelligent response rather than a dismissive, disdainful one. And it was, when I said I want to talk to you as a dad, that my Twitter handle exploded, and they gave me all kinds of names. And of the names, the one that I liked the best, or actually disliked the least, was Crypto Dad.
That's excellent. Well, there are so many places I want to kind of probe. Quick question, I want to move on. Is that joint working group, the CFTC, SEC working group, still meeting, or has that been disbanded at this point?
I don't know.
Not sure.
It was, I'll tell you one thing about running agencies. Even though you've got statutory frameworks and procedures, it very much is the tone from the top. It's about leadership. And both, Jay Clayton and I said, look, we've got to coordinate on this. We've formed this ad hoc team. They met every 2 weeks. And I understand it was still in place under my successor, Heath Tarbert. I don't know, whether it's taking place today, but I think it was quite effective during our time together.
Got it. So you opened the door, and you mentioned, former commissioner of the SEC, Jay Clayton. And, I know I recently read an op-ed that he published in the Wall Street Journal, which dates back to, I think, the end of December. So it's probably a month old at this point. And, there were a couple of points, I think, out of that op-ed that were interesting. The first of which is advocating strongly for and demonstrating the need for a digitized U.S. Treasury. So it's interesting now that, kind of listening to what you're saying before, right, in your remarks, now we have two former regulators that are publicly stating that the U.S. is behind in terms of their infrastructure, in terms of technology, perhaps even, regulation. Jay Clayton is suggesting that the U.S. dominance in financial markets is at stake. You've not gone as far in your remarks today, but do you agree with that assessment? Where do you stand on that?
So if you look throughout history, currencies have always competed against each other, and they've competed on many elements. But technological innovation is actually one of them. Go back 300 or 400 years, the currency that was most in demand in commerce between Europe and the North American continent was the dollar. But it wasn't the US dollar, it was the Spanish dollar. In fact, we named the dollar because we were giving respect to what was considered the best currency to have. And why was the Spanish dollar the one to have? It was minted with New World silver, which was more consistently pure than Old World silver, making it more fungible. And it used less alloy, therefore it was lighter to carry in your pocket or in your trunk. But here's the real interesting part. It was minted in such a way it could be broken into 8 equal pieces, known as pieces of 8, making it fractionable and therefore easier to use in commerce, requiring less change, et cetera, right? So it was a technological advancement of that currency over its competing currencies that made it more preferable and therefore probably traded at less than discount and had all those advantages, such so that when we created a dollar, we actually modeled it on the Spanish dollar. In fact, our dollar traditionally was also divisible into 8. It's divisible into 4 quarters, but a quarter could also be divided into 2, called 2 bits. You've ever heard 2 bits for a shave? Basically 25 cents. So the notion of dividing something into 8 pieces came from the Spanish dollar. So money has always competed based upon tech. All right, so take that as a given. We're now going from an analog to a digital opportunity for money. China is taking advantage of that opportunity. And yet, the United States, we're still saying, well, why do we need to do this? It works pretty good the way it is. Well, the risk is that money, whether it's the yuan or the digital euro, which is coming, are competing currencies modernize into a digital, fractionable, immediate 24/7, 365 framework, and we don't modernize our dollar. Now, maybe the dollar's other strengths, because it's not just efficiency and technological modernization that matters. It also matters a strong economy, the rule of law, stable economics, convertibility. All the other underpinnings of the dollar are substantial, and they're not going to go away not overnight. But why wouldn't we? The dollar became what it was because we modeled it on something that was technologically modern 300 years ago. Why wouldn't we modernize now? Now, we don't do it recklessly, of course. We've got to be thoughtful and careful and deliberate. We shouldn't try to do it overnight. But why wouldn't we think about modernizing? The same reason you modernize other infrastructure. You modernize airports, you modernize roads, you modernize transportation, all of which we haven't done enough of in our country. Are we going to have the same kind of slack response to the modernization challenge of currency that we've had to the modernization of airports and rail and other features? Or are we going to kind of get our act together and say we can't rest on our laurels? There's a new technology afoot, and we need to think about advancing our dollar, notwithstanding all its other strengths. We want modernization and you know what, if we do it, I actually think we could actually equip the dollar to compete for more generations and remain the world's reserve currency, because not only do we have all those strengths of stability and economic strength and convertibility and the rule of law, we'll now also have the latest technology.
That's so interesting. So, I mean, so first of all, the similarities that you're drawing right now are ones that I hadn't really thought about. I've always carved out financial services as an entity to its own and never really thought about in this context, which is fascinating. And the other part I think that's truly interesting is the amount of times we've talked during this course of this whole day, through this whole event, about things that are fractionally divisible as well. And those parallels back and forth against the old world, new world, where things that were old are new again, is really, really neat. There was another point, though, that you brought up and was also raised in that op-ed, right? And it was specifically talking about how we do what we're saying we do, right? Call it a securitized or a digitized treasury. Call it, the introduction of a Cbdc or whatever it might be. But the question is, how do you do that? And in that op-ed, there's a strong advocate for a private and public partnership. And maybe think about SpaceX and NASA. You bring it up again in your remarks a second ago. Can you talk a little about how that vision works? Is that where we are right now, whereby this is going to happen in cooperation, or you believe it'll happen in cooperation between the private sector and the public sector?
Well, I hope it does. I really do hope it does. I think whenever we've done big things in the United States, we've done that as a private-public partnership. I think that's the right way for democracies to do things. And, if we embark upon a digital dollar, we really want it to succeed. The worst thing we could do is roll it out and it's a flop. Well, if we do it as an official sector only, the chance of it being a flop are pretty great. When we do things well in the US, the private sector and the official sector work well together. And we need to bring the energy of the private sector, the project management skills, the ability to make sure that the social values of a democratic society are encoded in that digital dollar are vitally important. And, sometimes when we've done things only as an official sector project, and you can have your pick of names, I don't mean to be critical, but take FedNow and others, they don't exactly get delivered on time. And so I really think that the right way to do this is in private sector. I also think that, and I've written extensively about this in the latter chapters of my book, it's very important that a digital dollar not be the only payment mechanism. I believe that actually the ideal one is that you have both sovereign and non-sovereign means of payment systems existing side by side. The official sector has a lot to learn from the innovativeness that the crypto community has brought to the issue of global payment systems, cryptocurrency. So I think there's the ability to learn from each other. So I hope that the future is one of a great deal of diversity of systems, of a rich complexity and explosion of creativity. And in many ways, one of the things the Fed could do is lay down core principles and protocols and allow the private sector to build on that. Now, ultimately, central banks tend to take over money, and that may be ultimately the course. But I think we got a long way to go before we get there. But as I say, the worst thing we could do is do nothing for a few more years, see China or maybe even Europe succeed with digital currency, and then in a panic, cobble something together in a couple of weekend congressional sessions, chuck it out there, and it's a flop, right? If you want to be on time, you've got to start early. If we want to design, even whether we actually roll out a digital dollar or not, we've got to be experimenting now. The Fed with the private sector has got to be considering this carefully now. And if it's 5 years from now, 10 years ago, we make the decision, I hope we make the decision of a consensus of our nation to roll out a digital dollar. Hopefully it's extremely well designed, very carefully put together, technologically, monetarily, financially, commercially, and most important, value-wise, that it reflects the values. Web3 is the promise that we can do things without intermediation by big tech, but without censorship and having our data purloined by big tech. Well, what we don't want to do is make Web3. We've now gotten rid of big tech. We've just replaced it with big government, surveilling our data, censoring our activity, conditioning our economic responses. We've got to make sure that the future of Web3, whether people like that phrase or not, the future of the Internet of Value is one where our privacy is secure for illicit transactions, not for illicit, not for illegal, for illicit transactions. Our economic privacy, our economic liberty is assured from big technology companies or big governments or politicians and the like.
So news flash from today, for those who've been busy and haven't had a chance to see the news, we can probably say with confidence now that representing the private sector will not be Facebook or Meta or Diem or Libra, or call them what you will. But my question for you then is really on the public side, who are the agencies that need to be involved? You said Fed a second ago. Is it just the Fed, or who else would you stipulate needs to have a say here?
Yeah, so I think it's a broad range on the official sector side. It's market regulators. It's the Fed. It's Treasury, which is always concerned about the ability to issue its Treasury securities. And you mentioned Jay Clayton's, I thought, very helpful suggestion in that regard. It's law enforcement agencies as well, the ability to abuse a digital currency. It's national security agencies who are very concerned. The dollar plays such a critical role on the global stage, especially with its ability to execute sanctions power. So I think we need a full U.S. government engagement. But as I say, we absolutely need the private sector. We need our technology developers. We need the crypto community. Absolutely. If there's one place for the federal government starting today to consider the characteristics that will make a successful digital dollar, it's looking at crypto because of the success it's enjoyed. The technological capabilities, the open access, the immediacy, the simplicity, the efficiency. So I think look, we didn't get to the moon just by a government-run effort. There was a huge national engagement in that, engineering firms across the spectrum. We didn't explore cyberspace through it. Even though DARPA kicked it off, it was a huge private sector response to that core technological breakthrough. And those are the right paradigms for how we should be exploring digital currency in both sovereign and non-sovereign forms.
Well, I feel like I could ask questions all day long. I feel like I was a little bit of a kind of a novice policy wonk. Kind of this is been super fun. I'd like to thank Chris Giancarlo for his time today, for delivering remarks, which I think were quite helpful for me, and trying to understand the landscape even further, and to get a unique perspective from somebody who, during a very, very, very transformative time in our markets, was the head of one of the leading regulators in the United States. So, Chris, I want to thank you very, very much for that. I'm probably going to, ask you to sit tight for 1 second so I could just wrap this thing up. So I apologize. You're going to have to stand in front of the camera for just a minute.
The pleasure was mine, Gerald. Let's do it again.
Thank you. So on behalf of Arca, I'd like to thank all of our partners. We had an incredible day with speakers from all aspects of the industry. We had a significant number of partners that helped us today, and I want to thank them all. There are a couple other things I want to say before we wrap this up. Just notes for everyone here. Please be aware that the paper that we've talked about all day today will be released in February. The survey results that were discussed by David Easthope and Rain Steinberg was released already this week. And additionally, we'll be sending out a link via email to all the participants and the registrants regarding the sessions, and a link for them to view sessions on their own and remotely. On behalf of everybody today at Arca and all of our partners, I want to thank former Commissioner Giancarlo and all of our speakers and partners for putting on what I believe is the first of many in a series of events, but also one that achieved our objectives of educating the marketplace on digital asset securities and the opportunity for the future. Thank you, everyone, and hope you have a very nice day.